Hi, everyone. This is Sunil Sharma, Chief Investment Strategist at Ambit GPC, with our quick update, a 5-minute update on what's happening with markets. This month, we start by looking at exports, in particular, what's happening with U.S. Exports to the U.S. And what we find is most countries have experienced a significant decline in exports to the U.S. China is the biggest loser, down 42% year to date through November 2025. And Taiwan's the biggest winner with a significant rise in exports to the US. Now, what's more interesting is that India and China both, while experiencing decline in exports to the US, are actually up in terms of the global exports. So India's up 3.6% during the same period since Liberation Day, and China global exports are up 5.2% since Liberation Day. So both economies have effectively managed to redirect their exports and have survived the loss in the reduction in exports to the US quite effectively. Beyond exports, there's a lot more in terms of what's happening in the global economy, and we've got a lot of that in our commentary if you're interested. But moving on to look at some of the other indicators of what's happening with the U.S. markets and economy. South Korea semiconductor exports up significantly year over year, largely supplying to the U.S. Taiwan exports. South Korea's memory. Taiwan is semiconductors largely. And again, the exports continue to show very strong upward momentum and robust exports, particularly to the US. Now, one other indicator suggesting that there is a broadening, which we're also seeing in the Russell 2000 performance year to date in particular, is the Dow Transports, which is a proxy for the physical activity in the economy. The transports are actually showing a fairly strong trend, and that's a positive for generally speaking for the U.S. Economy. And even the consumer sector, the consumer discretionary sector is doing well. Again, positive for the U.S. markets. And like we said, the semiconductor index is verifying these data points that we shared earlier on South Korea and Taiwan. And the semiconductor index is actually leading the NASDAQ, which is typically positive for the markets. Beyond the macro noise, ultimately it's about earnings. And so these are the earnings trends for the NASDAQ and for the S&P 500, both showing very good momentum. The S&P with roughly 12% earnings growth year on year, trailing, and also forward estimates are shaping up to be around 13.9% year over year. And the numbers are better for the NASDAQ, 20% earnings growth of projected for forward earnings growth, and similar earnings growth coming through on the trailing as well. So both S&P and NASDAQ, as well as the Mag 7, continue to show strong earnings trends. We'll have better clarity once earnings start coming out on some of the Mag 7 this week. So to summarize on the US, and there's a lot more in the commentary, but what we're seeing is US markets and the economy are holding up and doing just fine. And the rally appears to be broadening. There has been some underperformance on the tech stocks in the shorter term, but that could be a function of rotation. Earnings will provide a better picture. The economy and the consumer remain resilient, and the wealth effect, as well as the capex spend, we think both are contributing to the US economy holding up and delivering growth. And both those trends remain in effect. We think increasingly AI is looking like it will bring real productivity. And anecdotally on conversations, continue to hear positive data on AI and the way it's coming through. So we remain positive on AI bringing real productivity enhancements. The US remains committed to winning the AI race, and much on this in the commentary as well. And should it be needed, the Fed remains ready to support markets, as it's becoming abundantly clear that healthy markets are a key pillar of the U.S. Economy as well. And the two primary drivers of the U.S. economy remain the wealth effect and the AI capex, contributing roughly 40 to 50% of economic growth. Coming to commodities, we share a lot of information about what we think is happening in the commodity space in the commentary. Please do check it out. But largely, number one, three trends that are driving what we think are going to is increasing or robust demand for commodities. Number one is AI, as we've spoken about already. We think AI will continue to garner significant capex, not just from the hyperscalers, but companies across the world. And number two is the energy transition, investments in EV, solar, wind, green energy are all going to require significant commodity inputs. And then finally, defense. And again, a lot of the metals are key inputs into the defense equipment. So there seems to be significant demand that is likely to drive demand for clean energy, demand for commodities all the way through at least 2030. And if you believe this chart, much further. Now, what's also happening is the US and China are in a race to garner supply chain security, resource security. And that was all precipitated by China using the rare earths, putting in rare earth controls, and then putting in silver controls, export controls, and so I think what's happening now is a significant rush to garner resources by not just these countries but others. There's also supply concerns. So ore grades have fallen. What used to the best mines have already been mined, and today it takes 70% more effort to get the same extracted ore. It takes far more time, energy, and resources. And so those are the trends we're seeing. We're hearing that supply can take years to come on, and most of these metals we are far behind in terms of visibility on new supply. And we get into more detail on each one of these individual metals in the commentary. Please do take a look. Coming to gold and silver, we've written extensively about gold and silver, and we've been long both since at least March, April 2024. And we continue to remain positive on the fundamental outlook on gold. And we've talked about all the reasons over the months and cover some of those. So the one that's notable this month is that gold holdings as a percentage of international reserves have overtaken U.S. Treasury holdings, and it's clear that what the trend is for gold and what the trend is for U.S. Treasury holdings. And we talk about all the macro reasons why this is happening. And underpinning gold demand remains central bank purchases. Central banks and even in terms of surveys on their plans for the next few years, central banks remain committed to building up their gold purchases. We also have our view and update on silver, and please do check it out. No change in terms of our view, though, on both commodities at this precious metals at this point. Coming to India, so over the last few months, certainly since Diwali, we've been listing a number of macro and bottom-up factors in terms of growth in sales, in and rising disposable income for the consumer. We are now adding credit growth to that list of indicators that are showing signs of recovery. Commercial credit to the commercial sector is up 14.5%. And the credit growth is being witnessed across small businesses, living, medium-sized industry, NBFCs, gold loans, services loans, etc. So broad-based pickup in credit is visible in the economy. Coming to markets, so markets have had a pretty tough go of it over the last few months, and 75% of the NSE equity universe is in a bear market, down 20% from 52-week highs. 41% are down 30% or more. So there's been significant carnage in equity markets. So what we'd say in terms of India equities is that we see when you look under the hood, things are improving. We also early indications are that earnings, particularly for the small caps and the mid caps, have been quite good, and large numbers or large percentage of the companies are reporting very decent numbers, particularly on profit growth. And what's been missing is the price reaction. We delve into the kind of setup that we're in, which is a U-shaped recovery, and we're getting to the point where there typically can be capitulation on equities, particularly due to boredom and impatience and a feeling that markets will never recover. And that is precisely the wrong thing to do at this point. We, in fact, think small caps in particular are approaching a bottom. And not there yet, but very soon. And mid-cap earnings continue to be strong. What's holding the markets back remains FI flows and the supply drain from a very strong lineup of IPOs, both last year as well as continuing into this year. Globally, like we talked about, markets doing well. So that's the view from now for now, and we look forward to. Thank you for joining me on this short video, and look forward to seeing you next month. Thank you.